Welcome back. While much happened on the trade front over the weekend, a lot happened for the banking sector too. State Bank of India announced a super market-beating Q3 results, while the Reserve Bank announced new rules which allow banks to insure their deposits depending on their riskiness and not a flat rate that they now pay. Again, RBI also kept rates unchanged at the Friday policy and hinted at what looked like a long pause. How will all this impact banks? I have with me Santanu Chakrabarti, the banking expert from BNP Paribas. Shantanu, good morning. Thank you very much indeed for joining me. Let me start with the happiest news, in a way for the market, but definitely for the stock. State Bank results. I mean, it's a beat on practically all parameters and certainly on earnings. What's your take? Have you upped your guidance?
Morning, Latha. So State Bank numbers, it's not just that the headlines that are strong if you go into the internals of that. For example, you might remember there was a fortnightly print of credit growth right before the latest print, which came in very high, hard to explain at 14.5%, which was explained by the fact that last 3-4 days of December, typically balances tend to pile up. But you look at the growth numbers, and domestic growth for State Bank was about 15.4%. And that's very broad-based across retail categories, across SME and all of that. If there's a mild weakness, it's only perhaps in CASA. In every other way, the bank seems to have hit it out of the park in the current quarter, for sure. And this definitely bodes very well for their incremental growth prospects, no doubt about that at all.
Okay, so
we are currently running with a system growth assumption of 13% in the next year as well. And, my FY26 13% growth number is now starting to look conservative. I've had that since the beginning of last year. At that time, it was significantly ahead of consensus. But I guess the consensus has now moved towards the 13% number.
Okay.
Even for this year.
Yeah, now, State Bank is a quarter to 30% of the banking system, or at least quarter% of the banking system. So would you up, because of the outstanding State Bank numbers, are you upping forecasts for banking sector in general? Are you expecting better loan growth and maybe even better margins because the governor seems to indicate a long pause?
Right. So right after that policy statement came out, we released a flash note arguing the same. See, Latha, we were expecting one final 25 basis point cut in this policy, right? Towards the end, as policy neared, the consensus veered towards no cut, and the no cut has what has come in. Now, obviously, this is better for margins, and typically the delta for a top tier kind of bank to a 25 basis point cut in this phase of the interest rate cutting cycle is about 2 to 3%. So in a way, whatever margin bottoming is to be done has either happened in third quarter or would happen in the current quarter for almost all banks. And therefore, FY27 earnings growth on FY26 gets set up very nicely indeed. I think, an earlier pause than was expected in terms of, no final rate cut, probably moves earnings by about 3 to 4% for the street as well.
Okay. Well, there's another thing that might move the earnings for banks, large banks, and that is the Reserve Bank's deposit insurance rules. It was, of course, the intention was announced, but now we have the concrete rules that the flat 12 paise for 100 rupees of deposits will apply to all banks, and for the less risky banks, it goes lower. How do you see that impacting earnings, and what would be your pick of the pack?
Look, in terms of stability of the banking sector, one of the most far-reaching impact policy points has been this deposit insurance. I mean, we have had across a set of banks in the last 5-7 years situations where people were afraid that deposit runs are going to happen and this and that, but nothing of the sort has happened. In one case, rescues have been organized, bringing in other banks and so on and so forth.
Yes.
So in some sense, one of the advantages that Indian banks were enjoying was that in some sense the liquidity risk was getting pooled, and a run, quote unquote, it was basically just ruled out by fact of that regulatorily guided cooperation and underwriting essentially that the system was doing. What this innovation now introduces is that underwriting is not at equivalent cost to all concerned. And there is now incentive for you to manage your own liquidity risks and your capital position in a way so that you can get cheaper insurance. So it introduces an element of meritocracy into the system. And as is the want in most such measures, obviously it is the stronger franchises which benefit on an affine basis, on an immediate basis. What we will see, therefore, is also that some of the smaller banks where, this aspect of liquidity risks, etc., may not be as robust as it is for some of the larger banks. Some of the behavior out there will also change because the deposit cost insurance, especially when we are going into an easing cycle, if not further on rates, but definitely on liquidity, and prime end of the market is likely to become very competitive, people will care about that incremental deposit cost over the cycle. So you will see some shift in behavior for sure.
Oh,
For the
okay.
positive.
Okay. Then that'll make it life even more easy for those who are already strong, because people
Right.
will migrate to what is perceived as less risky banks. So, Shantanu, then what is your pecking order in terms of banks now? Do some of the PSU banks move higher? Clearly, this time they have beaten the private banks hands down.
Look, one of the popular thesis in the market right now, and the current data seems to bear it out, is that PSU banks are set for very strong market share gain. As you know, unlike past cycles, this time, they have the right technology and the distribution initiatives to go on and compete head on with the private banks. But in all this euphoria, let me just again point out something that I have pointed out to you before, that right now all PSU banks and definitely SBI is also still running at a level of credit cost which is probably a little lower than what can be considered sustainable. I'm not talking about last 15-year averages, which will have, of course, very critical periods of very big losses. Let's rule all of that out. Let's assume that the worst of such cycles are not something we need to keep into consideration right now. But even on a steady state basis, the current credit costs for the group probably look a little unsustainable to me.
But Shantanu, 1 minute. I'll stop you there because I'm short on time. I expected this argument that, for 2 quarters I've been hearing that, the credit cost advantage is over. But now there is a new LDR advantage. See, private banks are already at very high LDRs, especially HDFC Bank. Whereas State Bank has only now moved to a loan of 80 for deposits of 100. If you look at BOB, you look at PNB, you look at all the other banks, they have a huge runway in terms of being able to increase their loans compared to their deposits because Reserve Bank now is okay with it. So there are some advantages. Do you think PSU banks are going to do better than private banks in the coming days?
No, I think some of the top private banks, our top picks, HDFC, ICICI, Axis, also have the benefit of being significant discount to what their long-term valuations look like. And, that gives them advantage. If not so much ICICI, definitely HDFC and Axis. And as to your point on LDRs, Latha, tell me something. If we go back 18 months, every single RBI, communique or press conference
There's a
or
warning on
speeches
LDR.
made by various functionaries all mentioned LDR all the time. When was the last time you have heard LDR mentioned by RBI in the last 6 months?
Okay.
There was a question in the policy
Yes.
press conference right after the MPC regarding
Yes.
LDR. And the RBI basically said that LDR is part of the cyclicality of the banking system. Sometimes it goes up, sometimes it goes down.
No.
So you read into that what you will. I don't think it is going to be a very valid metric to be looking at over
Fair
the
enough. Yeah.
next 6 months or so. And growth clearly remains the priority. And this is why, when the policy communiques are coming, they're focusing so much on maintaining liquidity plumbing and all of that because
No, I
they
agree
want
with you.
healthy growth.
I was just pushing my luck, maybe. It's just that, you can't keep on growing your loans if you don't grow your deposits. You will end up depending on CDs. So anyway, your margins will fall. I take your point of that. Shantanu, we haven't had time to look at NBFCs, but I saw that you have a very positive view on Bajaj Finance. The results were somewhat underwhelming. You still think that it can command the kind of valuations it commanded? It'll still do well. It'll still grow at 22, maybe 24% AUM growth. But its valuations are declining, aren't they?
Its valuations
Multiples.
valuation multiples have declined, but something to keep in mind, Lata, that even their long-term growth guidance, they have not moved a lot. And the interesting part of the Bajaj Finance story is try and studying that, customer triangle. You do understand that these people have added up almost 3 crore customers in the last 2.5 years, right? And these are, I mean, initially you come into the system as a smaller ticket customer, and then there's levels of filtration which get applied, wherein a surviving final group gets to becoming a large ticket customer within Bajaj Finance. So, I mean, competition aside, therefore, just looking at that triangle gives you a very good sense of, given what the filtration rates look like for each category of customer, where the growth can end up in the next 5 to 7 years. And I think that is one of the reasons that the management has not moved their growth guidance too much. You can see what kind of focus they have on AI ML. And they said something. They said it's not like we are operationalizing AI. AI is operationalized and part of our business already. I think it's still at this scale it's hard to believe, but it's still a early to mid 20s kind of growth story going forward. With decent 20-21% kind of ROEs. And that's rare, Lata, and it will always command a premium. And when you have 16 years of track record of maintaining that kind of growth without asset quality accidents, you will get a little bit of a premium. But I take your point. I mean, the quarter wasn't anything to write home about. On top of that, they have built a provisioning war chest for themselves. So, the earnings optics look even worse. But I don't think the fundamental pieces have moved.
Oh, right. Well, we have a lot more questions, but on another occasion. Thank you very much, Shantanu, for joining us with your analysis of the big developments in the banking space over the weekend, especially the State Bank results. That's it on this edition of Bazaar. Thanks much for watching. Chartbusters coming up.